We have big, important breaking news this morning. China is striking back. In just the last hour, Beijing announced it is now slapping new retaliatory tariffs on all U.S. goods by an additional 50%, bringing the total tax on U.S. goods headed there to now 84%.
As a response to the U.S. tariff strike, China has put a 34% tariff on all goods from the U.S. This includes soybeans, which are very important to Trump's economic and political base, as well as pork and corn. All of America's most important farm states were hit hard, and the losses have been substantial. Farmers across the Midwest, who formed a crucial part of Trump's voter base, now face uncertain markets and plummeting commodity prices, threatening their livelihoods and the economic stability of rural America. The U.S. sent about $15 billion worth of farm goods to China in 2024 alone. Soybeans made up more than 60% of that amount. These trade relationships, built over decades of careful diplomacy and market development, are now at serious risk of collapse. China's tariff wall keeps getting taller and thicker, but Trump isn't giving up. He hit back hard by raising taxes on Chinese goods to 50%. This brought the total tariff rate to an all-time high of 104%, the highest level in the history of trade between the U.S. and China. However, China's leaders are leaving the door to talks slightly open. They've said they're willing to consider a new type of trade deal, potentially similar to agreements made during Trump's first term, but the United States' demands remain at odds with the reality of a 104% import tariff. Mr. Trump has pushed the United States and China into the most dangerous economic conflict in their history, one that threatens to upend global supply chains and rewrite the rules of international commerce. The impact has been immediate and severe. In just one trade session, more than $700 billion in market value was lost globally as investors rushed to adjust their portfolios in response to the escalating tensions. China has also become stricter with rare metals exports, raising questions about the future of the U.S.-China relationship and threatening key industries from electronics to defense. From the start of the year, the White House took a series of bold steps: a 10% tax in February, another 10% in March, followed by a sudden rise to 34%. Each announcement sent shockwaves through global markets, disrupting supply chains and forcing businesses to hastily revise their operational strategies. The president now plans another 50% hike, potentially bringing the total tariffs on Chinese goods to an unprecedented 104%, a level that many economists warn could trigger a global recession. Consider the practical implications for American consumers. A $20 toy will cost $40, placing strain on family budgets. An iPhone that costs $400 will now be worth $800, potentially slowing the upgrade cycle and hurting both Apple and its vast network of suppliers. The price for each car could increase by $6,000 to $12,000, threatening the already fragile recovery in the auto industry and potentially costing thousands of jobs in manufacturing and sales. The president insists this is necessary punishment for Beijing, especially since China has already retaliated with its own tariffs. But many wonder if American consumers will ultimately bear the brunt of this economic brinkmanship. China responded immediately with a 34% tax on all U.S. goods, targeting industries in states crucial to Trump's political base. But that's only the beginning of Beijing's strategic countermove. China announced limitations on rare earth exports, materials that are essential to modern technology and military applications. China controls up to 90% of the world's supply of elements like dysprosium, praseodymium, terbium, and neodymium, giving it enormous leverage in this critical sector. Though not widely known to the general public, these elements are key to manufacturing electric vehicle batteries, military radars, semiconductors, and night vision devices. Without reliable access to these materials, U.S. technology firms and defense contractors face potentially crippling supply shortages. U.S. companies seeking these materials must now apply for licenses from Chinese authorities, which are not easily obtained and subject to unpredictable approval processes. Analysts are calling this a de facto export ban with global implications. The Pentagon has already expressed concern about the potential impact on military readiness, while tech executives warn that innovation in key sectors could be delayed by years if alternative sources aren't quickly developed. The rare earth restriction represents China's most potent non-tariff weapon in this escalating trade war. Asian stock markets crashed following Washington's threat, erasing months of gains in a matter of hours. The Hang Seng Index in Hong Kong fell more than 13%, the biggest drop in almost 30 years. The Shanghai Composite fell more than 7%, losing $500 billion in market value as investors fled equities for safer assets. The ripple effect spread to other Asian markets, with Japan's Nikkei and South Korea's Kospi experiencing their worst trading days since the COVID-19 pandemic began. The shocks were also felt in U.S. markets, triggering circuit breakers in temporary trading halts. In just a few days, Wall Street fell between 10% and 15%. Investors rushed out of hedge funds and into treasury bonds, driving yields to historic lows as capital sought safety amid the uncertainty. Many financial experts have called this economic shock treatment potentially catastrophic, warning that continued escalation could trigger a global financial crisis worse than 2008. Retirement accounts across America lost trillions in value, causing many workers to postpone retirement plans indefinitely. The two economic giants are now playing a game of who blinks first. But this isn't like any other standoff. The entire global economy is watching with trepidation as two nations that account for over 40% of world GDP engage in increasingly dangerous economic warfare. Small nations are particularly vulnerable as they lack the economic resilience to weather prolonged trade disruption. The world's largest economies have essentially created a trade blockade with these extraordinarily high tariffs. What is the real objective behind these moves? Is the U.S. government trying to increase revenue through tariff collection, to encourage domestic manufacturing by making imports prohibitively expensive? Or is this simply a psychological maneuver to gain leverage in broader negotiations about technology transfer, intellectual property, and market access? Meanwhile, Beijing claims that Washington's tariff policies damage the global economy, violate international trade rules, and threaten the world economic order that has lifted hundreds of millions out of poverty. Chinese officials have begun calling for reform of international institutions like the WTO, positioning China as a defender of globalization against American unilateralism. The gap between them has grown into a deep chasm, with little diplomatic communication occurring at senior levels, despite the escalating stakes. In a single press conference that was broadcast globally, President Trump made statements that triggered the loss of approximately $10 trillion in global market value. Markets worldwide were already unstable when Trump took office, and his refusal to halt tariffs was perceived as a direct threat to the foundations of global trade. Investors who had hoped for a more moderate approach were shocked by the aggressive rhetoric and immediate policy actions. Financial experts described the resulting $10 trillion market value loss in just 1 week as a tsunami that eroded investor confidence almost overnight. This market collapse wasn't caused by new legislation or a natural disaster. It stemmed from a single statement that suggested tariffs could rise even further and that no sector would be spared. The velocity of the market reaction surprised even veteran traders, who noted that automated trading algorithms likely amplified the downward pressure as key technical indicators were breached. Following the U.S. imposition of a 25% tariff on imported cars and auto parts in March 2025, Germany reacted strongly. With 30% of its exported cars going to the U.S. market, Chancellor Olaf Scholz criticized the strategy as misguided and harmful to workers on both sides of the Atlantic. In a nationally televised address, he reminded viewers that German automakers employ thousands of American workers in their U.S. plants, which now face uncertain futures. German automakers like Mercedes, BMW, and Volkswagen expressed concerns about disruptions to global supply chains that have been optimized over decades. The German Industrial Association warned that thousands of jobs could be lost if the conflict persisted, particularly in regions already struggling with economic transition. Germany's message was clear: in a trade war, no one wins, and workers and consumers on both sides suffer the consequences of political brinkmanship. The U.S. raised taxes by 25% on all Canadian goods, except oil and gas, in February 2025, shocking America's largest trading partner and closest ally. Prime Minister Justin Trudeau accused the U.S. of interfering with Canada's sovereignty and natural resources. His successor, Mark Carney, called it an attack on the world's most successful bilateral trade relationship, one that supports millions of jobs in both countries. Canada responded with a multifaceted strategy, boycotting American goods where alternatives existed, promoting cultural independence from U.S. influence, and embracing a wave of modern nationalism that positioned Canada as a defender of rules-based international trade trade. Canadian consumers began actively avoiding U.S. products, with smartphone apps helping shoppers identify domestic alternatives. The economic impact was particularly felt in border states, where retail and tourism revenues from Canadian visitors plummeted. In an unprecedented move, the EU and Germany stood against the U.S. and welcomed Canada as a strategic partner in defending the multilateral trading system. The 2025 Hanover Industrial Fair chose Canada as its official partner country, the first time a non-European nation had received this honor 2 years in a row. The exhibition halls featured extensive Canadian technology and manufacturing displays, with German businesses actively seeking Canadian suppliers to replace American ones. Simultaneously, the EU-Canada CETA trade agreement was revitalized with new provisions to deepen integration, enabling bilateral trade without U.S. involvement. EU officials began discussing the possibility of a common approach to digital taxation and regulation that would exclude U.S. tech giants, potentially creating a parallel regulatory regime that could marginalize American companies in European markets. Mexico initially remained silent after the U.S. imposed a 25% tax on their goods, taking time to assess the full implications for their deeply integrated economy. President Claudia Sheinbaum issued a measured response in March 2025, stating that they would address specific issues at appropriate times rather than escalating rhetoric. She characterized America's defensive posture as baseless and insulting, particularly given the $800 billion annual trade relationship that had been carefully built under NAFTA and its successor agreement. Behind the scenes, Mexico began diversifying its export markets, signing new trade agreements with South American nations, and deepening ties with the EU and Asian partners. Mexican officials also reached out to Canadian counterparts to discuss coordinated responses to U.S. pressure, potentially creating a North American alliance that excluded Washington, an ironic reversal of historical patterns. The formula behind Trump's tariff policy has raised eyebrows among economists and trade experts worldwide. Investigation revealed that the administration calculates tariff percentages by dividing the U.S.'s trade deficit with each country by the total value of goods that country exports to the U.S., a simplistic approach that ignores the complexities of global trade. For example, with China, $295.4 billion trade deficit divided by $438.9 billion in imports equals a 67.3% tariff. This mechanical calculation fails to account for services trade, where the U.S. often maintains a surplus, or the role of global supply chains where components may cross borders multiple times before final assembly. Many economists criticize this as an overly simplistic calculation that fails to account for actual tariff practices by trading partners. It punishes countries based on macroeconomic factors like savings rates and currency valuations, rather than unfair trade practices. This approach has led to 10% tariffs on dozens of countries with which the U.S. maintains a trade balance, creating confusion and diplomatic tension with longtime allies. The policy creates uncertainty for businesses planning investments, disrupts supply chains that took decades to optimize, and ultimately increases costs for American consumers. Small businesses have been particularly hard hit, lacking the resources to quickly find alternative suppliers or the margins to absorb higher input costs. In March 2025, China abruptly announced it would cease importing LNG from the U.S., shocking global energy markets and leaving American producers scrambling to find alternative buyers. This was viewed as direct retaliation for the 10% tariff imposed on Chinese goods a month earlier, and demonstrated Beijing's willingness to use energy purchases as a geopolitical tool. The U.S. lost access to its second-largest LNG market without warning, with billions in long-term contracts suddenly in jeopardy. China quickly redirected its LNG shipments to Europe, avoiding U.S. tariffs while increasing its influence in a market seeking alternatives to Russian energy following years of tension. European importers welcomed the additional supply options, despite American diplomatic pressure to maintain solidarity against Chinese trade practices. Australia seized the opportunity created by this disruption by signing a $1.5 billion deal with China Resources Gas, one of China's largest energy conglomerates. This 15-year agreement, beginning in 2027, will provide 600,000 tons of LNG annually, replacing much of what China previously purchased from American suppliers. Australian LNG is not only 20% cheaper than U.S. gas, but also takes 10 fewer days to transport due to to proximity, giving it significant competitive advantages in the Asian market. This represents more than a business transaction. It's a geopolitical statement with long-term implications. Australia, traditionally a U.S. ally in the Indo-Pacific region, has become China's primary energy partner, potentially shifting regional power dynamics. Australian officials privately expressed frustration that they weren't consulted before the U.S. imposed tariffs that disrupted global markets, and saw the LNG deal as necessary economic pragmatism rather than a deliberate pivot away from their American alliance. The U.S.-China trade war has evolved into a multi-dimensional global economic conflict with far-reaching implications that extend well beyond bilateral relations. As tariffs escalate and nations realign their trade relationships, the international economic order faces unprecedented challenges. Traditional alliances are being tested, and new partnerships are forming in response to perceived American unpredictability. The ultimate cost to consumers, workers, and economies worldwide remain to be fully understood, but early indicators suggest significant pain across multiple sectors. Supply chains built over decades are being reconfigured at enormous cost, while consumers face higher prices for everyday goods. Workers in export-oriented industries face particular uncertainty, with manufacturing jobs at risk despite promises that tariffs would protect domestic production. As the world enters this new era of economic nationalism, the post-World War II consensus around free trade and multilateral cooperation appears increasingly fragile. Whether this represents a temporary disruption or a fundamental realignment of global economic power will likely depend on the outcome of this high-stakes game of chicken between the world's two largest economies. For now, the rest of the world can only watch and prepare for continued volatility as the U.S.-China relationship deteriorates further.